Good morning, folks, for another episode of the Daily Read with Jeff Kikel. Welcome to another crazy day in the markets. We are in the midst of a lot of craziness, especially in the AI and data trade. We'll cover a little bit about what I think is continuing to go on and what I've shared over the last 3 days. For the last 2 weeks, the stock market's been telling us two completely different stories at once. The average stock keeps making new highs while the AI and chip names have quietly fallen into their own bear market. Today, we find out which story is going to win, and it comes down to the next 30 hours. And the scoreboard still continues to say the same. This is a rotation, it's not a breakdown. Money keeps leaving the crowded AI trade and flowing into the rest of the market. Financials, healthcare, industrials, airlines are doing extraordinarily well, and they've got the earnings to back this rotation. The average stock is doing very well, telling us that despite Iran's risk, the oil prices, companies are still making good money, and the consumer, while stretched, is still resilient. Yesterday, the Dow jumped over 1%, back near record highs. Today, everything's down, while the tech-heavy NASDAQ slipped again and continues to slip today. Same market, opposite directions. The story hasn't changed, but today it gets stress tested hard. Here's the evidence. The breadth of the market, the equal S&P 500, the average stock, set yet another high yesterday. When the average stock is at records, this is not a market in trouble. The leadership is really healthcare, which continued and rose 2%, financials and airlines, while the semiconductors fell 3.5% and keep sliding. That's not fear, that's money changing seats. In the credit and rates market, the bond market stayed calm and yields eased to 4.6%. And aside, before even earnings confirm it, outside of tech, companies keep beating and raising guidance. Every gauge points the same way: reallocation, not retreat. So what does this mean for you? It's the same reminder, and it matters more this week than most. The market and big tech are not the same thing. For 2 years, owning a simple index fund quietly became a concentrated bet on a dozen AI names. And that bet is the part that's unwinding. The broad market around it is holding just fine. This is the week to look honestly at what you actually own, not to react, just to know. Now the test, two things over the next 30 hours. This afternoon, the Federal Reserve decides on interest rates. Now, they are expected to hold at this point, but that's not a guarantee. And it's the tone about what comes out the next that the markets will hang on. Chairman Warsh has his presser at 2:30 this afternoon. That's where we're going to get a handle on that. But one of the things that the new Fed chairman is really stressing is they are not giving predictions about the future anymore. They are taking the data as it comes, and they're trying to encourage others to do the same and not hang on everything that the Fed says. Then tonight, the two largest tech companies report, Microsoft and Meta. And how much they plan to spend on AI is the number that moves everything. If credit stays calm through both, the rotation is healthy. If it cracks, the story changes, and that's what I'm watching. There's a massive, mostly invisible trade where big investors borrow cheap yen and buy assets all over the world. And if Japan steps in to defend its currency, that trade can unwind fast, the way it did back in August 2024. This isn't a crisis in the making, but it's a market hiccup risk, not a system risk. But it's exactly why, even in this healthy rotation, I'm keeping a little cash on the sidelines. So that's your daily read for the day. I do these every day, so please subscribe to the channel. I'd love to hear your thoughts on what I'm saying every day, and we'll be back here tomorrow.